Rebecca Felton is with us. She's Senior Market Strategist with Riverfront Investment Group and a new face to CNBC. We welcome Sherman Haig, the CEO of Tectonic Advisors. Good to see you both. Thank you both for joining us today. Rebecca, you have been overweight technology anyway, but I would think even you have to be surprised at the move that we've seen relative to the rest of the market that technology's gone through.
Well, thank you for having me. And certainly you've got better resilience in the tech earnings and revenue streams, even looking into the second quarter. You hesitate to say that they're only going to be down single digits. Anytime you have the word only and decline in the same sentence, it's probably not a good thing. But down single digits versus the overall S&P down 40%, you understand how that looks relatively better. And with the adaptation that all companies are seeing, the fact that many schools are starting back virtually, the trends in tech will probably continue for some time. So it's probably worth it to pay up for that quality of earnings and revenue. And
my apologies sincerely to Haig Sherman as we welcome you to the CNBC program. You look at a broad sector here, not just technology, but where does tech play in your portfolio right now? Are you as overweighted maybe as Rebecca is right now?
We have been overweight, and I think that if you look at tech, I agree with Rebecca and also your previous guest, which is it's really become a safe haven place for people to put money. If you look at 0% interest rates, there really is no opportunity cost with investing in tech names. The durability of earnings, the earnings growth, and the lack of alternatives have really made it a place where investors feel comfortable placing their assets, and we're no different.
Even if you've got device makers where demand is down, even if you have social media companies where advertising is down, I mean, Haig, there are reasons fundamentally to be skeptical about this move. Calling it a safe haven is a little much, isn't it?
Well, again, perhaps, but if you look at, obviously, these companies do have some economic cyclicality to them. So you are seeing year-to-year earnings declines in some of these companies, almost all of them, in fact. But if you look, for example, at Amazon, you're going to have 30% year-over-year revenue growth. And what the market says is, while their earnings are down, in effect, they will transcend and then over the next year or two, get their cost structure in line and start delivering earnings. And again, I think this is a throwaway year for most investors as it comes to earnings. They're really looking at the durability of the franchise and what the franchise will look like on the other side of this COVID era.
Right. Rebecca, what are your expectations for the earnings we mentioned earlier that are coming out this week? And bearing in mind that some of these companies are already down, what, 10+% from their most recent highs as we get ready for what are expected to be tepid earnings at best?
Well, I think a lot of it's going to depend on what people say as they give their guidance, or if they give their guidance. You know, we've seen so many companies prior to this earnings reporting period discontinue it, yet during Q2 season, we've actually seen some companies, including some in the technology space, start giving numbers again for the full year 2020. So what they say is going to be much more important than the earnings we report. And we're still early in. So I think that there could be some bumpiness, again, owing to the valuations that we talked about earlier, but it's still, from a relative basis, probably the best sector to be in right now in terms of having a little bit more of that than the benchmark.
All right. We will see what happens when the earnings start coming out this week. Rebecca Felton and Haig Sherman, thank you both for joining us today.